Risk management in investment refers to the process of identifying, assessing, and mitigating potential risks associated with investing in financial instruments such as stocks, bonds, mutual funds, or other investment vehicles. The primary objective of risk management is to protect the invested capital and maximize returns by effectively managing and reducing the impact of various risks. Here are some key aspects of risk management in investment. Risk identification. The first step in risk management is to identify and understand the different types of risks that can affect investment portfolios. These risks can include market risk, liquidity risk, credit risk, operational risk, geopolitical risk, and more. Risk assessment. Once risks are identified, investors need to assess the probability and potential impact of each risk on their investments. This involves evaluating factors such as historical data, market conditions, economic indicators, and other relevant information to gauge the level of risk exposure. Risk measurement. Risk measurement involves quantifying the potential losses that may occur due to specific risks. Common methods include value at risk, VAR, stress testing, and scenario analysis. These techniques help investors estimate the potential downside and make informed decisions about risk tolerance and asset allocation. Risk mitigation. After assessing and measuring risks, investors implement strategies to mitigate or reduce the impact of identified risks. This can include diversifying the investment portfolio across different asset classes, industries, and geographic regions to spread risk. Additionally, the use of hedging instruments such as options, futures, or derivatives can help offset potential losses. Monitoring and review. Risk management is an ongoing process that requires regular monitoring and review. Investors need to stay updated on market conditions, economic trends, and any emerging risks that could impact their investments. Adjustments to the risk management strategy may be necessary over time to adapt to changing circumstances. Risk communication. Effective risk management also involves clear communication of risks to investors or stakeholders. Investment professionals should transparently communicate the potential risks associated with different investment products or strategies, helping investors make informed decisions based on their risk appetite and objectives. By implementing robust risk management practices, investors aim to minimize the impact of adverse events and increase the likelihood of achieving their investment goals while protecting their capital. Implementing risk management in investment involves several steps and considerations. Here is a general framework to help you get started. Set investment objectives. Clearly define your investment objectives, including your desired returns, time horizon, and risk tolerance. This will serve as a foundation for developing a risk management strategy. Identify risks. Identify and categorize the potential risks that may affect your investment portfolio. Consider risks such as market volatility, interest rate changes, credit defaults, liquidity constraints, geopolitical events, and regulatory changes. Assess risk tolerance. Assess your personal risk tolerance, or the risk tolerance of your organization. This involves understanding your ability and willingness to take on risk. It's essential to align your risk tolerance with your investment objectives to find a suitable balance. Diversify your portfolio. Diversification is a key risk management technique. Allocate your investments across different asset classes, example, stocks, bonds, commodities, and within each asset class, example, different industries, geographic regions. Diversification helps reduce the impact of a single investment or sector on your portfolio's overall performance. Conduct due diligence. Before investing, conduct thorough research and due diligence on the investment opportunities. Understand the fundamentals of the investments, analyze financial statements, assess the management team's track record, and evaluate any potential risks specific to the investment. Implement risk mitigation strategies. Based on your risk assessment, implement strategies to mitigate specific risks. This can include using hedging instruments like options or futures contracts to protect against adverse market movements, maintaining cash reserves for liquidity purposes, or employing stop-loss orders to limit potential losses. Regularly monitor and review. Continuously monitor your investments and regularly review your risk management strategy. Stay updated on market conditions, economic trends, and any emerging risks. Make adjustments to your portfolio and risk mitigation strategies as needed to align with changing circumstances. Stay informed. Stay informed about relevant market and industry news, economic indicators, and regulatory changes. This will help you identify potential risks and adjust your investment strategy accordingly. Seek professional advice. If you are unsure about risk management techniques or need assistance, consider consulting with a financial advisor or investment professional who can provide guidance based on your specific circumstances and goals. Remember that risk management is an ongoing process. It requires regular evaluation, adjustment, and adaptation to changing market conditions and investor objectives.